Hello everyone, welcome to the first As Good As Gold podcast by Hugo. As good as gold is a phrase referring to being very well behaved or in a very good condition or state, which is literally what Hugo is about on our financial well-being. Now we want to help everyone regardless of background and or status to be good stewards of our finances, get it to a good state and stay there. Now that's what wealthcare is about. No point getting there and then losing it, right? So we want to get there and then stay there. Now I hope you're as excited as I am because this is not only Hugo's first podcast, but it's my first podcast. I'm literally new to this. I've never done a podcast before. This is the first time doing it. And it's so trust me, it's I'm quite stressed right now, you know. And also the guest today is somebody who actually pays me my salary, so double stress. So okay, you must support, yeah? Listen already, subscribe, share with friends, listen again, subscribe again, share some more, and just keep doing it over and over and over again. Alright, but okay, jokes aside, my guest today is Ben Davies, co-founder and chief operating officer of Hugo. He's been in finance for a long time and is one of our resident expert on gold. You might know him if you've seen some of our videos before. He was on a recent Seedly TV, giving a webinar together with the folks at Seedly talking about gold. So he's no stranger to us. He's no stranger to you, I hope. And yep, he's our resident expert on gold. Now, Ben, just intro yourself for those who have not met you.
Hi guys. Hi Raymond. I think you've done such a bad job. I think we're going to have to reduce your salary substantially. No, I think that's fantastic, and I want to give you credit for. I love the name, As Good As Gold. I'm not sure that my mother would say that I was as good as gold growing up, but you need a little bit of naughtiness in your life, don't you?
You just have to act like as good as gold. Whether you are as good as gold or not, doesn't matter.
Yeah, I think it's what we're trying to achieve here with this podcast is to give people, arm them with hopefully with the most salient and useful information to make good decisions about how to improve their financial well-being. So I'm really looking forward to the podcast and watching the journey of a number of people come on. But I think you're a natural host, so fantastic.
Yeah, this means I'm a good hire, right?
Absolutely.
Right, yeah.
Everyone loves Raymond, but that's showing my age. But that's a very famous sitcom in America, probably in the 70s and 80s, which I used to watch reruns of.
So many people make that joke about my name, but to be frank, I've never watched it before. Never, not even a single episode. I have no idea what it's about, but that's for another time. No, but wait, Ben, you got to introduce yourself first. You got to tell people who you are, your experience. Why should people listen to you on this podcast? Why should people take you seriously?
Great question. Why should people take me seriously? Well, I think I've made some good and bad decisions over probably the last 4 decades. But my background and probably why you want to call me a resident expert is that formerly I used to run a hedge fund, and one of those funds was a gold fund where I invested in physical gold so we could protect investors' money, really more as a portfolio diversification. They would come into our fund and we would provide an allocation into gold that typically we outperform the gold price over a period of time. We also invested in mining companies, which is very different risk asset profile. So I'd probably spent a decade running that fund. Very interesting journey. We set it up in 2006. I formerly was a head of trading at a large investment bank in the US, and I was running interest rate trading, and I had a kind of a bird's eye view, let's say, of the coming credit crisis that we suspected could brew. Really, I started to think it could come to fruition in 2005, but actually the tipping point was when interest rates rose and put a burden on people's ability to finance the excessive debt and credit that was manifestly building in the system at the time. So I left that company and positioned myself and investors' money into our hedge fund, our alternative investment fund, so that they could protect themselves against the credit crisis and the fallout from that. And it was a really successful sort of decade where gold rose significantly during that period. But we can talk about that more later.
Oh yeah, definitely. So thanks for introducing yourself, your background, why we should take you seriously, why people should continue staying tuned to this podcast. Now, okay, so Ben, today I have invited you to be on this podcast. You should be proud of it. You're the first one to be on this podcast, inaugural. But today I just want to pick your brains a little, right, and discuss, because look, I think for anyone in Singapore, Singapore is generally a rather financial. Our population is rather financially savvy, right? Generally speaking, so more or less we know that when we invest, we don't just want to jump in headlong into risky assets. There should be some kind of protection going on. There should be some kind of there should be a conservative element, right, in our portfolio, whether buying into commodities or buying into safe haven assets, diversification, and so on and so forth. So we have been talking about investing in gold as a way to protect and preserve our wealth. Now, the pertinent question then is, how then do we determine how much gold should we actually need? I've talked to a lot of friends, right? And most of them generally agree that you should buy into some kind of safe haven, and gold is one of them. But you ought to know how much to buy into it so that your portfolio is performing optimally, right? Regardless of course, not talking about what kind of economy we're going into, but generally speaking, just making sure it's at its optimum performance in good times and bad times. Yeah, so as a Singaporean, we all have that question, but nobody knows how much to determine, and is there any general rule of thumb? So today I'm going to talk to you about that. Now, gold along with other instruments are used as hedges against investment risks. So for listeners who are not very familiar with this, can you explain what a hedge is and why is it important to have it as part of our portfolio?
Yeah, it's funny. We were talking earlier before the podcast, aren't we, about where did the word hedge originally come from? And I think I know I've learned this in the past because I've had the question come up, but I think it's often used in terms of hedge your bets. And I mean, really, what is a hedge trying to do in terms of financial terms? It's about reducing risk exposure. So you can do that on an individual stock basis, you can do it on an asset basis, you can do that on a portfolio basis. But in the context of what we're talking about, I think it's probably prudent to talk about portfolio diversification. And portfolio diversification, we could have, let's say, a basket where we have, let's say, a traditional portfolio historically in the sort of 90s, early noughties of this century was a 60% equity, 40% bonds. And as we moved into an environment with very low interest rates, people began to realize that portfolio mix had to change because it was extremely volatile. And returns on bonds, once they started to near the zero bound or the zero rate, really sort of changed that return profile of that overall portfolio. And I imagine that if a lot of asset prices have gone up because there's been candidly a lot of liquidity going to the market. And I think that's one of the biggest driver of asset classes over the last, frankly, 2 decades. And you can see that very clearly. You can measure liquidity going into the system through something like money supply M2, and you can see as that moves up and down over a 6-month period, that typically correlates with what we call risk assets like equities and bonds, particularly moving higher or lower accordingly as that liquidity comes in and out. As a function of that, it became very evident that you needed to dampen down the volatility in that portfolio. Pension funds wanted to potentially, or risk managers needed to have more certainty on that return profile. So, I mean, I'll give you an example. So if you add gold, and this is the ultimate question that you touched on earlier, it's like, how do you know how much gold to add to that portfolio, whereby what you're effectively going to do, you add that weighting of gold to your equity and bonds, you're going to smooth out your returns. You're probably going to reduce your overall returns on that portfolio. But at the same time, the drawdowns in that portfolio over any given period, whether it's a month, a year, 3 years, 5 years, depending on that weighting of gold, will also come down. So your drawdown volatility gets less. So there are ways to measure what percentages you have. You can ostensibly back test over a 20-year period. Now, that's an historical view, that if you weighted 5%, 10%, how much will that reduce what we call the annualized volatility? And all that is a standard deviation of sort of the variation in price over the course of a year. So if you think about when we're all at school, the normal distribution curve, 1 standard deviation, positive or negative, 2 standard deviations. What gold does, and this is the key thing, it dampens down the volatility in a portfolio of, let's say, equities, bonds, real estate, so significantly that in systemic risk, like the GFC, the Great Financial Crisis in 2008, you actually had a negative correlation, meaning for, let's say, 1% move in stocks down, gold would move up X percentage. So you had one asset class going down, another one going up, smoothing out your overall return. So imagine you've got 50% in equities and you had 10% in gold. If gold went up, let's say 5%, and your equities went down 1%, broadly, you've smoothed out your return there.
All right. Is gold the only asset class that behaves like this, or is it just one of a few others?
I think the answer to answer you, gold is uniquely the best hedge, the best portfolio diversification. This is data as well recorded, as well known. If I was to take a commodity basket that included agricultural commodities, let's say it took sort of hydrocarbons, oil, gas, etc. If I took other metals and I added those to create a similar weighting instead of gold, the reduced volatility would not exist. In fact, actually, you may well be adding volatility to that portfolio. So the beauty of gold is it can have both a negative correlation, like I just described. So while one asset's going down or up, gold is doing the opposite. But it also can have this is what I love about gold, it can have a positive correlation. So would you believe over the last 20 years, gold probably has been, other than maybe emerging markets, has been the best performing asset class?
Yeah, I think I saw data on that.
Yeah, on a par with, so the last 50 years, gold has returned average 10% a year. And that's in line with US stocks. Think about that. Most people don't understand. And that's with reinvestment of dividends. So, yeah, that's an incredible stat that most people don't understand. So why does gold often work even in positive economic times? It's because there's that wealth effect where people are making money, often in the asset classes of stocks and bonds that are going up. They then might decide to diversify some of those returns into gold. So that leads to more investment in the space. But typically, the last 20 years, it's because we've reduced interest rates, or central banks have reduced interest rates below the level of inflation. So if inflation on average was running at 3.5% to 5% for 20 years a year, we've taken them down to zero. So we're running at what we call a negative real rate. So you take the CPI, the consumer price index, let's say, of 5%. If the rate is zero for central bank rates, then you've obviously got a negative 5% real rate. That is a very positive environment not only for stocks because of the future discounting, but it's also really positive for gold because there's no carry cost then associated with gold.
Wow, okay, so that's a lot of information. Now, that's more on a global scale. We are talking about generally speaking. Now, I want to zoom in into the Singaporean context, right? Gold for Singaporeans. Now, can you tell me what's the benefit of buying gold today for Singaporeans? What's unique about the way we invest that makes gold, to you, in your opinion, important to factor into our portfolio?
That's an interesting question. I think that it doesn't matter what nationality you are. Gold obviously is priced in fiat currency terms, isn't it? Or it could be priced by weight. But in reality, gold was once money. It isn't today because it's not required by legal tender to be used to pay taxes. In terms of, if we want to talk about savings and investing, because you're very much talking within the context of portfolios, I believe that having been on what we call a dollar standard, where the US dollar was the hegemonic, the supreme currency, reserve currency of the world, as you can see that central banks have ultimately built up significant reserves of dollars. Because we've not been anchored by the stability of gold as a percentage weighting of those dollar reserves, there hasn't been a restraint on money printing and the issuance of money, really, in order for governments to be supported by central bank money supply. Now, as a factor of that, I tend to think of gold as a money proxy, even though it's not legal tender. For myself, I've talked about this before, I think on the Seedly AMA, but if you think about the Maslow hierarchy in terms of financials, whereby in Maslow hierarchy is the first sort of the base foundation of your triangle, for those that are familiar with it, is that we need the basics to survive, food, water, shelter. So think of gold as that base, whereby you have a significant foundational saving base in gold. I've just explained to you that it makes 10% annualized, somewhere between, the last 20 years it's actually been 14%. But if you smooth that out and say over a period of 10 to 30 years, it's around 7 to 11% average return, you are significantly protecting yourself against inflation. So if you left your money in a bank account, whilst you will get the return of that money, you are losing money every year to the tune of maybe 5, 6, 7% as the inflation rate is going up now. And that's significant. So 7%, I think, annualized, probably in somewhere between 7 and 10 years, you've lost 100% of your money. So if you have it in gold and that's outstripping by 4 or 5% the inflation rate, you're already protecting yourself. Now, I would say that in any currency that you're in the world, that you should be creating a base of savings on that basis. Now, if you need the money immediately, that changes your profile of how much you would save in gold, because obviously there will be fluctuations in any given month, in any given year, in any given period. Take it to portfolios and put it into that context. So let's say that I put 5% of my salary into gold every month, so I'm building my savings. Now I want to put 10% as part of a portfolio, which I think is an optimal amount, to smooth out a volatility of returns of, let's say, equities, bonds, and real estate trusts, ETFs, for example. I would say that. Sorry, the question was about was it the amount of allocation, or
what's unique about gold that that the Singaporeans should buy more? Now, because why I asked that, right, is because you said, now you also covered that gold is a way where you can save your money in, and it's a reliable way of preserving the value of your savings. Because you touched on how if we had left it in a bank, when we finally draw it out maybe 10-20 years later, it will have lost a significant portion of its value. Now, Singaporeans already have the CPF. We already save our money in CPF, a huge chunk of it. In fact, I think it's about 36%, 16 on the employer side, 20% from our side. So we effectively, even if we don't save a single cent in our bank account, we still kind of have, as long as we work, we have 36% saved away in CPF, which generates returns of about 4% a year per annum, right? So some Singaporeans think that we are already saving enough, and if we are generating 4% every year in our CPF, by the time we retire, we draw it out at 55, or we leave it in there all the way till we die, it guarantees some money, some kind of growth.
So the question for me is, what is the asset mix of that portfolio that's in the Central Provident Fund that gives you a 4% return? Which, by the way, a 4% return is that, what's the volatility around that? I gave you two examples of, you could have a 7% return, but the portfolio itself could have an annualized volatility of either 5 or 20. And we all know which one we have, because at any given point, you've got that vomit moment where you realize you've lost 30% of your savings. You've got the exuberance of, oh, I'm up 50% on it. Yeah, there's no free lunch. You know, crypto space might look like it's giving a free lunch, but it's going to hurt most of the investors, speculators at some point. There will only be a few who really make out. Now, and normally that will be towards the end of that cycle. So my question would be, what's the asset mix? Secondly, it's obviously not keeping up with the inflation rate. So you're losing money against inflation. You still have your money. It's not like you've lost it all. It's just it won't buy you as much. So your purchasing power has been markedly reduced. Now, if you add gold to that mix and you come into, let's say, I'm also going to tout Hugo, which is a very clean, cost-effective way to invest in gold that's truly buying the underlying physical asset. And that's the most crucial element, that's legally owned by you in secure vaults. If you do that and add 10% of your savings, of your salary each month, and what we would call a little, often an early, average cost investing in, you will end up creating far more significant returns relative to that Central Provident Fund. Fact. Right, the numbers support that historically and will continue to support that while we're in the environment that we're in, which is deeply negative real rates.
Let's focus on the individual investors now. Local investors today, the way, even I myself, I invest I still invest not a lot, not too aggressively, but I still do. So local investors like us, the way we invest and the things that we invest in are kind of different from before. Right, if you think about, in the Singapore context, when I think about my parents, right, they would buy into stocks. These stocks are in maybe say DBS Bank, Singtel, generally the very reliable stocks in Singapore. But investors today, the younger ones like myself, and even people who are younger than me, have almost a whole different basket of investments. We have conventional investment instruments that have existed for a long time, like endowment plans, fixed deposits, bonds. Like I'm talking about government bonds. In Singapore, we have the SSB, the Singapore Savings Bonds. It comes out, I think, promising about 1+ to 2% interest rates. Stocks and ETFs, right? And generally, these are stable instruments, not really very exciting, but gives decent returns, with the exception of stocks, of course. I'm talking about endowment, fixed deposit, and bonds. Now, today we have new age investments like cryptocurrencies, NFTs, alongside popular instruments that people my age, my friends, are increasingly into, like REITs, right, real estate investment trust. And these have associated risks, and they add onto the Singaporeans' financial risk exposure. a lot of my friends, my age, we are millennials, right? We are kind of in the workforce for a while already, but not long enough to really have saved up a huge stash or a reasonably huge stash of cash. And then we venture off to invest in volatile asset classes like cryptocurrencies and NFTs. Do you think that is wise if we don't have a sufficient base and then we go into these new age instruments per se?
This is really the debate of our time, isn't it? Let's create some context, right? We are living in a very, very new monetary financial system from the standpoint of both the monetary system and way people have engaged in providing capital to really fund projects. I think that it's interesting. It's like a lot of individuals. You mentioned an older generation tended to invest in some of well-established names because they feel that they're going to be around for a long time, and they're strong, stable businesses, almost like utilities. A bank is almost like a utility in the sense it should create a dividend and annuity every year. Now, of course, regulations did change over the course of 20 years, so these banks became more like hedge funds, and they were taking on significant risk by leveraging up what we call their balance sheet. So for every dollar they have, suddenly it went from 10 times risk to 100 times risk, let's say. I mean exaggerating the point, but that's a whole different ballgame. That you're going to have extreme volatility of returns for a company like that. A lot of people are piling into Tesla now, when they should have been piling into Tesla 20, it hasn't been going that long, but let's say 5 to 10 years ago. And I think the biggest issue for young investors and actually older investors like myself is because central bank liquidity is such a big driver of asset prices, creating this risk on as liquidity comes in and then risk off as it comes out. We've become disconnected between what are appropriate valuations on a cash flow basis for a company. So we've got multiples on names like Tesla, which unless they continue to grow at the exponential network that they suggest, they're overvalued by 50 times. I use that as an example. This is our difficulty.
Yeah, you remind me, talking about Tesla reminds me, the investment profiles, the investment behaviors among people my age, the millennials, right? We are a little bit more adventurous. We are a little bit more responsive to what's new in the market, right? New news, new stocks, interesting stocks to meme stocks. We even have meme stocks, meme coins. So,
can I just interrupt you there? It's not, and we will come around to crypto and NFT. It's not that every generation tends to have more risk appetite, simply for the reason that everything's new in the world. They're on the whole more likely to want to experiment, right? They haven't had the brutal hard knocks where you've made a mistake and you've overinvested and you've lost all your money. They haven't had those. Until you go through that type of situation, you're quite rightly, you're full of can do. And actually, it's really important as an individual that as you get older, you don't get too jaded by life, that you don't become cynical. You must keep open to opportunity. As I consider myself an entrepreneur now, where if I didn't have an open mindset and was closed to thought processes in running, let's say, our business together that we're doing, we will fail because we're living in an incredibly dynamic environment. I think the thing that's changed for your generation is you have greater access. So the internet comes in 2000, but I remember having a modem. In 2000, right? Sorry, what did I say?
Yeah, 2000, yeah.
Yeah, so call it 98 to 2001, you've got the explosion of the internet. And obviously that is what evolved over the next decade, where what's happened is we've had a monopoly by the big players who are the creators and owned it. And you talk about NFTs. We're now going to walk into a place where NFTs will give much more power through, let's say, Web3 to the creators, because they're going to have much more control and authenticity over what they've created. That's not to digress from your point, though, and well, my point here is you've had, because of the internet, it's truly democratized knowledge. Companies like ours are giving instant access to asset classes, to crypto blockchain applications that we didn't have. But there was always the new thing back then was getting access to a stock that was, let's say, pets.com was a big one. Fantastic run up in the stock. And then everyone realized that it was completely overvalued and it went bust when it ran out of money, because actually, 2 million clicks doesn't necessarily result in a bunch of customers online, right? So I think that it's, from a psychological standpoint, you're no different, you're no more special than we were.
Right, but I agree with you. Just now you said, right now we have greater than ever access to various kinds of financial instruments. With trading apps, robo-advisors, anybody can start trading. Now, because of that, and the kind of things we get to trade nowadays, there's so many classes, so many things to diversify, so many things to buy into. Because of the even more diversified portfolio, the nature of it, why is gold still important? Why is hedging still?
You just made a big assumption there that there is a more diversified.
You have more ability to diversify. How about that?
What? Yeah, okay. I don't think that's correct.
Okay.
I think there is a lot more choice about how to express investing in a particular asset class. There are bonds, equities, commodities, real estate, and of course now there is new cryptos, and let's call it altcoins and NFTs. That's the additional capital that potentially is taking away money from traditional. Sorry, this is the new capital issuance that is taking away money from what, let's say, traditional investment environments. And I think that's the big play here, right? Because money is coming under threat as a concept, and the internet and programming has developed so much. There are these very smart people who've said, I think there's a better way to create money, a more stable form of money. Unfortunately, it's becoming abused. Bitcoin was set out to be, for example, a peer-to-peer payment system, but right now it's a risk asset with an 85% annualized volatility, which is 5 times as volatile as or more than something like gold. That is not a store of value. It's not proven itself. Gold is a store of value over 3,000 years, turning a nice return of 10% for the last 50. Fantastic. This is the new exponential effect of technology. You've got access, I've got access. We're now getting billions of people who didn't have access to these markets in an era of significant liquidity increases who can put capital into these markets. So they're going to extreme valuations that have no bearing on what their underlying value is. I'm not using what is the underlying value of Bitcoin. Well, if it became like the Visa network, you can start to annualize what should it be worth on an annual basis in terms of revenue for the miners. That's how you can start to actually work out the value. We haven't created more natural diversification. That's not the case. We've just added another asset class, which is not a diversifier. If anything, you just created a speculative instrument sector, which is sucking in money. And a lot of people will lose money in that sector. Once the network effect has petered out and matured, there'll be like an S-curve. You'll make no returns in it. You'll have to average invest in at the right time if it's still around.
So we've talked about how gold is a hedge for against investment risk, against volatility. It appreciates when there's more money injected into the economy. Inflation, we're talking about that. And then, of course, we're also talking about, in Singapore's context, more Singaporeans right now, especially the younger ones, are putting more money into investing in more speculative assets. Well, one example is crypto, NFTs. So we've got that. Now we covered why it's important to hedge. Now, going to the main question, we need to talk about how much to hedge. How do we determine how much gold we need? Now, generally, we Singaporeans consider portfolios, we think a little bit more simplistically, right? We Singaporeans consider portfolios to fall under three different groups: aggressive, balanced, and conservative. Now, what they mean is anybody's guess, right? What to me is aggressive may not be aggressive to you, but generally we kind of understand this: aggressive, balanced, and conservative. Now, so I have with me here examples reasonably representative of what I think are aggressive, modest, and aggressive, balanced, and conservative portfolios. And I would like to hear from you. I would like you to offer your take. Where do you think risks exist in each of these groups, each of these portfolio examples? Assess the level of risks and how each of these three investors should hedge, with gold being a part of it. And then you can maybe share your general rule of thumb. So the first persona, all right? Anyway, for the viewers, this is real. I really got in touch with people, and this is the portfolio I got. 40 to 50% of this person's income in tech stocks. For example, Palantir, Tesla, CrowdStrike, C as in the parent company of Shopee, Google, long and call options, and crypto like Bitcoin, Ethereum, and Luna.
So when you said long and call options, what do you mean?
This person didn't really explain, but he said it like this. Okay,
I think what he probably meant is he's long some call options on some of these equities as well. So he's
possibly, yeah.
So he's got
40 to 50% of his income.
So each month, 40 to 50% of his income, he is investing into these companies. So is he dollar averaging in?
I doubt so.
So he's just bought them at one point in time and he's sitting with them.
Yep. Yeah, he doesn't dollar cost average.
So is it 40 to 50% of his? Because if he's, let's say I pick a number, he earns $100,000 a year. Is he putting $50,000 a year into this portfolio?
I think over the course of a year in tranches, not doing a stable. Sometimes when he sees the performance, he sees some certain indications in his performance, then he may decide to buy more of it. So he's not really doing DCA.
So he, from time to time, he will the way he saves is to take on pretty aggressive risk, right? So I mean, he's an example. What's his age?
30 to 35.
So he's that classic. So he's part of this generation whereby he is investing what I would call, whether he realizes it or not, he is thematically investing into the network effects that are happening in the world with large companies in the tech sector, like Palantir, Tesla, CrowdStrike, C, etc. Obviously, they are all benefiting manifestly from this exponential, the age of the exponential, let's call it. So they also are benefiting from the double whammy of liquidity going into those stocks, particularly in an environment where there isn't really many alternatives, because bonds lose you so much capital appreciation. You're kind of almost forced to take on more risk. So, adding in Bitcoin, Ethereum, and Luna, I mean that volatility on that portfolio, I mean, he could lose in any 1 year easily 50, 60%, and even in a relatively benign year. So for me, it's like any equity or asset class that you buy into, you can always buy at the wrong time, right? You can buy, if you buy, let's say, what turns out to be the high, either in price or in valuation or both. If you do a discrete buy in time, if you're just lucky enough to get in the cycle at the right time, which nobody really has the time to look at. Nobody can market time well. Even professionals can't market time well on any long period or short period.
Not all the time, not 100% of the time at least.
Yeah, if someone tells you that, this is a good example. This is a quote. I'm making 10% a year for the last 15 years. I've had no drawdowns, no negative months. If someone says that to you, and they say invest into that portfolio, run.
Yeah.
I tell you why. Because that was said by an investor in Madoff. It's a Ponzi scheme, right? You will have, if you're having a 10% return, you will have significant volatility in this environment of the last 10 years.
So for somebody with such an aggressive portfolio, what would you advise?
He needs to diversify that. He's got too much of the same risk on. He's literally, he thinks that why is he invested in Palantir, Tesla, CrowdStrike, Google? He hasn't got enough diversification in those stocks anyway. When markets correlate, typically most stocks in a systemic environment where liquidity is going in and out, all of the stocks tend to go down or up together. Sure, there is some rotation and some companies have some value, but I would argue that you really need a minimum of 20, 25 stocks in a portfolio. And you need to be, whatever the criteria you use, it's got to be across a number of different sectors. Otherwise, he might as well just buy an index, or he just might as well buy one stock. He's probably replicating the risk there right across the board. He could literally represent that with one stock or just Bitcoin.
I put all 50% into that.
Yeah, it's all the same stuff. He hasn't got enough diversification there.
Right. So how much gold should this guy hold, or percentage-wise? Or how should he start to calculate? First off, what was his objective with that? If he's just trying to earn more money, get rich.
He's not earning. He's not earning. Earning is when you get income and you take that income. He has got open market exposure to capital risk. It's like going to the casino and being at the craps table, and you go from, oh no, this is what seriously, right? You're not investing, you're speculating. You go to the craps table, you think the odds are in your favor, they never are, they're always at the house. Okay, it's not quite as extreme, but this is the analogy. I've now moved from $5,000 put down on the craps table, maybe I'm up $400,000 throughout the night. I've had a few martinis that have emboldened me as I've shaped the dice and rolled away. And lady luck, you're riding all the way. And you're thinking, I've earned $400,000 tonight. No, you haven't, because you haven't taken it off the table.
Yep. It's not materialized yet.
Off the table, he hasn't earned anything.
Yeah. Okay. Now the next one is a balanced, in our perspective, is what we consider balanced portfolio. 20 to 25% of income in SGX stocks. For example, property REITs in, let's say, CapitaLand and Mapletree, in the construction sector, banking, such as DBS, OCBC, UOB Bank, and telcos like Singtel.
Right. So a balanced portfolio, when you say it's 20 to 25% of income, I think this is what I'm finding confusing. So if someone, are you saying again, someone's got $100,000, let's say they've got $100,000 income, you're saying they're putting 25% of their income a year, so $25,000 into a balanced portfolio.
Yep.
So but for me, what's important is, I think what would have been useful to understand, and apologise for stating this now, but is what I more want to understand is what is their income, and then what is their percentage of the savings that they're investing in this. So I think about, I've got a bunch of savings, and then how do I allocate that savings? Do I put it in a bank account? Do I put it into an investment portfolio? Oh, and by the way, I've got my income, and then out of that income, how much am I adding each year out of that income? How much am I saving a month to add to that savings pool I already have? So first off, that's how I would look at it. So it does impact how I can answer this. So we'll go on the basis someone's putting $25,000 a year out of their $100,000 into SGX stocks only. So that to me now is like 100% of their savings for that year is going into Singaporean stocks. Well, that obviously is not a balanced portfolio because you're putting all your eggs in one basket. If you tell me they've got a savings pool of 100% of which 25% is going into SG stocks, I'd need to know what are the other asset classes investing in. But let's just go with they're putting 25,000 into SGX stocks. The biggest risk with that, you're replicating similar risk because as we know with COVID, Singapore has been exposed to, as most economies, but particularly Singapore, if construction gets hit, if shipping gets hit, the banks get hit.
Yep.
Every market will get hit. There's not enough diversification. This is an example of someone buying blue chip names that probably over the long run will do well. So if you average in every year and you keep doing that for a number of years, sure, if you believe in the Singaporean economy, they will continue to do well. Personally, I think Singapore has had an incredible run in its history. I think it will continue to benefit as the with ups and downs in the same way that sort of Zurich and Geneva has in Switzerland. There's this bastion of let's say wealth management businesses growing, as it's seen as an area of a country of good governance where you can protect your capital. So money will come in from Indonesia, ex-China, other ex-China names, and even China, of course, through various corridors that we know, even though there is capital controls. So I think, that market will continue to be underpinned. But I would go a balanced portfolio. I need to invest in other emergent or emerged markets outside of that are not all at risk of the Singaporean economy.
So we covered aggressive and balanced portfolio. Now, the conservative portfolio. This person put 40 to 50% of his income into predominantly savings instruments. 40 to 50% of his income split among commodities, including gold, endowment plans, and the Singapore savings bonds, and does regular top-ups into his CPF. Really conservative.
How much percentage-wise is in commodities?
About 20% of half his income, about there.
I think 20% weighting in commodities is really good for the next decade. I think commodities are significantly undervalued relative to equity prices, historically on a cyclical basis, at levels that are generationally cheap. And I think if you continue to invest on a continuous basis after putting a chunk of money in, that's a smart move. He's obviously balancing that out, or she's balancing that out with sort of fixed income assets. So those fixed income assets, you talked about the Singapore savings bonds, frankly, at 1 or 2%. Look, the commodities element is going to provide the returns in the portfolio. 1% return is just, you're losing so much money relative to inflation. I think it's a waste of time, but you are at least getting the return on your capital. I personally probably would have moved into a wider basket of bonds where you get slightly higher yield. In terms of the endowment fund, what is the provision asset allocation within that endowment fund?
I don't have that information.
Now, if there's good weighting of equities in that and real estate, then I think this guy's actually got more of a balanced portfolio. I think it's a great portfolio.
Cool. So actually, out of these three that I found, the conservative one seems to be, in your opinion, way more balanced than the other two, even for what I thought is a balanced portfolio.
Yeah, we're moving into very extreme environments in terms of how we create portfolio protection. So for me, I have a 25% weighting in commodities, heavily weighted, 10% of which is and this is in my pension portfolio, 10% is in physical gold, 15% across a even weighted commodity basket across agriculture, softs, other metals, etc. I have a significant weighting still in what I call the age of exponential, because I think that technological innovation is here and network effects are going to be significant for a lot of the tech companies that, whilst they've overreached, you want to keep buying into. So I've kept a 25% allocation to those. So right now I'm at a pretty high 50%. I have a global property REIT, which is 15%. Frankly, for want of something better to do, I think property in general can create sort of annuity returns, but you could have some capital destruction in that at various points. But I think it will do fine over a 20-year period. And then the rest has been allocated into. I've got an emerging market, which is 15%, and then the rest is in emerging market bonds. And I'm looking at diversifying into potentially, and this is China still, and that's the one I'm less sure of. But valuations have come back down. And I think that despite the interventions by the government, it might be worth me having 5% of my portfolio in that.
Now, final question. Now, I think this is where there are gold fanatics and then there are gold skeptics. What would you say to people who want to go all in on gold, all in? And then, so that's the first group. And what would you say to people who want to have nothing to do with it at all? So first group, what would you say to people who want to go all in on gold?
I'm not going to sit here and proselytize to people about what they should or shouldn't do. This is the great thing about humans. Like everyone has a subjective preference, right? And what some might think is irrational, another might think is rational. In terms of to be true to our whole discussion now, it really doesn't make sense to go all in into any asset class, because there is significant volatility in your capital structure that, if you need that capital, can have a really detrimental impact on your health. Because frankly, we do live in a consumptive world where there is a lot of assignment of one's sense around their wealth and status with that. I'm not saying that's right. That's just a reality of for many of us surviving in the world we live in today. I think most young professionals are swimming against the tide. You know, young families, professional families want to give their kids the best opportunity because state education is not very good in some countries. The biggest inflationary environment has been private schools, right? People literally are working, excuse my French, their arse off every day. And they think they're wealthy, but they're not. It's just going out the door. They're not saving anything for their future. So in terms of gold, is like love it or hate it. It's like Marmite, if that's a familiar spread in Singapore. It is certainly in the UK.
Not really, but we know what that is.
Yeah, Vegemite, Marmite. Yeah, you love it or hate it. Gold. But actually, people just need to just have an objective view. Look at the data. The data is telling you that gold has made 10% annualized on average for the last 50 years. In fact, 14% over the last 20 years. Have it as your mainstay savings. Just put minimum of 10% in aside every month, in my opinion, as part of a portfolio.
10%.
10% of what you're saving, right? That's not that much. Put 10% in as a portfolio diversifier. I personally have effectively told you I have, between commodities and gold, I've got 25%. But it's primarily, I think it's somewhere between 10 and 15 in gold. I've had higher weightings because I was running a gold fund. So at one point, I've experienced what it was to have 50% of my wealth in gold, because that's how I started my fund. And while that worked out really well at the time, I had to start blinking my eyes on the volatility of that fund, because it has a material impact on your psyche, right?
Yeah.
So if I've answered your question, Everyone's got their own choice, but I think don't ignore the data. Don't have an emotional attachment to any investment. It's all about the return profile.
So thanks, Ben, for really going so in-depth into how we should look at our portfolio, understand what diversification really is. It's not about buying a bunch of stocks or a bunch of instruments, but buying different classes of instruments that work somewhat differently. Am I right to say that, Ben?
Yeah.
Right, and then to not go all in into any asset classes, to not have emotional attachment to any one of it. For gold, you want to have some, and do you say that for whether you're aggressive, balanced, or a conservative investor, you want to perhaps put about 10 to 15% of your savings every month into gold? Just buy a bit by bit over time. Am I right to say that? Is that your rule of thumb per se?
Yeah, I think average costing into any asset class is really a very prudent thing to do. I also increase my allocation when I see that values and price are, aligned to warrant, let's say, taking a bit more exposure. So I may well increase an allocation. And notice, Raymond, that there are two distinctions here. Price and value are often conflated. Price is where buyers and sellers agree on a unit in which they want to exchange. They clearly disagree on value.
Wow, okay, that was really a lot of information, and thank you so much, Ben. I think those were invaluable nuggets of wisdom that you have collated and you have accumulated over your many years of being a fund manager and a trader. Now, I just want to remind everybody that Ben here is the Chief Operating Officer and the co-founder of Hugo. Now, Ben, right, since you're the co-founder, I'm going to give you the last word. Why don't you tell our listeners what Hugo is?
What Hugo is an all-in-one application that takes people on an integrated customer journey, whereby ultimately we help you through three pillars: save, spend, and invest. And in order to really save and invest enough, you need to understand your expenditure. So we help you analyze what you're spending, and we give you money saving tips and mechanical, actual automated ways of switching, let's say, out of certain utility providers, perhaps getting discounts, perhaps substituting some of your products for others, so that you make effective savings. And we call those savings without sacrifice, because you haven't had to give up any of your lifestyle. We've literally moved you, let's say, from one mobile provider to another at a $10 discount each month. So think about that. You immediately saved $120 in the year. We then encourage you to auto invest that into one of our portfolios or gold. And then you just, as I said, set it and forget it. And what we're wanting to do is create positive and reinforcement, little nudges and hooks that will reward you with sort of financial incentives, or it might be with a discount at one of a store, to want you to continue to save. Frankly, we want to get you hooked to saving. Unlike a social media platform that's trying to unethically hook you into behavior, we have no shame in saying that we want to hook you into saving as a drug. And I think that's really good for everyone.
Right. Thank you, Ben, for giving that lowdown. So, guys, remember, Hugo is here to help you spend, save, and invest, starting with gold, right? And like what Ben said, we're here to help bring financial well-being, or help you on that journey towards financial well-being by helping you to develop healthy financial habits where you spend smarter, save more, and grow your wealth faster. Right. So thank you for your time. I hope to see you on the next episode of As Good as Gold. All opinions in this podcast should not be regarded as offering any financial advice. Listeners are encouraged to seek advice from a qualified financial advisor regarding the suitability of any financial strategy, taking into account their specific financial objectives, situation, or particular needs before they act upon any recommendation.